You're sitting across from someone at dinner. They're doing well. Good job, nice apartment, seem to have it together. The conversation shifts to investing and they mention they're 100% in stocks because bonds are for old people. You smile, nod, keep eating, but here's what just happened. They told you they don't actually understand how money works at a systemic level, and most people don't catch that. Most people think bonds are just this boring thing your grandpa talks about, a safe investment that barely beats inflation, something you worry about when you're 65. And that fundamental misunderstanding? It's why so many people get blindsided when markets move in ways they didn't see coming. I'm not here to sell you bonds. I'm here to explain why, if you don't understand bonds, you're missing the foundation of how modern finance actually operates. And once you see it, you'll never look at money the same way again. Here's the thing. When most people think about investing, they think stocks. That makes sense. Stocks are exciting. Companies grow, stock prices go up, you make money. It's a clean story. Bonds feel like the opposite. You lend money, you get it back with a little interest. Boring, right? But here's what they're not telling you. Bonds are the backbone of the entire financial system. Not stocks, bonds. The global bond market is over $130 trillion. The stock market? About $110 trillion. Bonds are bigger, and they're not just bigger, they're foundational. Every interest rate you've ever encountered, every mortgage rate, every car loan, every credit card APR, every business loan, it all traces back to bonds. Let me show you why. When the government needs money, it doesn't just print it. Well, technically it does, but that's a whole separate conversation. What it primarily does is issue bonds. A bond is a loan. You give the government $1,000 and they give you a piece of paper that says, we'll pay you back in 10 years and we'll pay you 4% interest every year until then. Simple. Now, why does this matter? Because that government bond, that 4% return, becomes the baseline for everything else. It's called the risk-free rate. Risk-free because the US government has never defaulted on its debt. If you can get 4% risk-free, why would you accept 4% from a corporation that might go bankrupt? You wouldn't. So corporations have to pay more, maybe 6%, maybe 8%. Riskier companies pay even more. Now look at what just happened. The bond market determined the price of money. That 4% government bond just set the floor for every other investment, every loan, every financial decision in the economy. When bond yields go up, everything gets more expensive to borrow. When they go down, borrowing gets cheaper. This is the game. And if you don't understand this, you're playing financial checkers while everyone else is playing chess. Most people don't realize that when the Federal Reserve says they're raising interest rates, what they're actually doing is influencing bond prices. Here's where it gets interesting. Bonds have an inverse relationship with interest rates. When rates go up, bond prices go down. When rates go down, bond prices go up. This confuses people because it seems backward. Let me break it down with real numbers. You buy a bond for $1,000 that pays 4% interest. That's $40 a year. Now imagine the Fed raises rates and new bonds are paying 5%. That's $50 a year on the same $1,000. Your bond paying $40 a year is now less attractive. If you wanted to sell it, you'd have to discount the price. Maybe you sell it for $900, so the buyer still gets an effective 5% return. Your bond just lost value, not because the government became riskier, but because rates went up. This is what happened in 2022. The Fed raised rates faster than they had in decades. Bonds got crushed. People who thought bonds were safe watched their bond funds drop 10%, 15%, even 20%, and they panicked. But here's the part that separates people who understand money from people who don't. Those losses were only real if you sold. If you held the bond to maturity, you still got your money back. The price fluctuation was just market noise. But the psychology is brutal. People see their safe investment dropping and they bail. They lock in losses. They move to cash, which is getting destroyed by inflation. And they miss the entire point of what bonds actually do in a portfolio. Bonds aren't there to make you rich. They're there to stabilize. They're there to give you something to rebalance into when stocks crash. They're there to produce income when you need it. And they're there to help you sleep at night when the market's doing something insane. You might be thinking, okay, but I'm young. I don't need stability. I need growth. Fair, but answer this. What did you do in March 2020 when stocks dropped 35% in a month? Did you buy more or did you freeze? Be honest, most people froze, or worse, they sold. And the reason they froze is because they were 100% in stocks with no cushion, no dry powder, no psychological safety net. If they had 20% in bonds, they could have rebalanced, sold some bonds, bought stocks at a discount, and made a fortune when everything recovered. Let me give you another angle. Right now, you can get around 4.5% to 5% on a treasury bond, risk-free. Meanwhile, the average savings account is paying, 0.5%, maybe 1% if you're lucky? People are leaving thousands of dollars on the table because they don't understand that bonds are an option. They think bonds are complicated, or they think you need a brokerage account and it's too much hassle. But you can buy treasury bonds directly from the government in about 10 minutes. No fees, no middleman, just you and the U.S. Treasury. And yet, most people don't do it because bonds feel abstract. They feel like something other people deal with. Here's the deeper truth. Understanding bonds means understanding risk. Every investment is a trade-off between risk and return. Stocks are risky, so they offer higher potential returns. Bonds are safer, so they offer lower returns. But safer doesn't mean risk-free in terms of price fluctuation. It means you know what you're getting if you hold to maturity. That certainty is worth something, especially when you're trying to plan a life, when you're trying to retire or buy a house or fund your kids' education. You can't plan around uncertainty. You need some pieces of your financial life that are predictable. Bonds give you that. Now, there's a misconception that bonds are dying, that with inflation, bonds are a terrible investment. And sure, if inflation is 6% and your bond pays 4%, you're losing purchasing power. But here's what people miss. Bonds adjust. When inflation rises, bond yields rise to compensate. That's the market working. And if you're reinvesting those bond payments, you're buying new bonds at higher rates. Over time, it evens out. The people who got burned were the ones who bought long-term bonds at 2% right before inflation spiked. That was bad timing, not a flaw in bonds as a concept. And here's the shift most people never make. They think about investing in terms of individual assets, this stock, that bond. But real wealth is built through portfolios, a mix of things that work together. Stocks for growth, bonds for stability, real estate for diversification, cash for liquidity. It's not sexy, it's not a story you brag about at a party, but it works. It works over decades. It works through recessions, bull markets, crashes, recoveries. And the people who understand this, who understand that bonds play a role in that system, they don't panic when things get weird. They adjust, they rebalance, they stay the course. There's a saying in finance, bonds are return of capital, stocks are return on capital. Meaning bonds give you your money back, stocks make your money grow. You need both, because life isn't just about growing wealth, it's about protecting it, accessing it, and using it when you need it. And if your entire financial strategy is built on things going up forever, you're setting yourself up for a reckoning. So when someone tells you bonds are boring or that they're for old people, what they're really telling you is they don't understand how the financial system is structured. They don't understand that every major institution, banks, pension funds, insurance companies, governments, runs on bonds. They don't understand that the price of money itself is determined by the bond market. And they definitely don't understand that the next time markets get volatile, the people with bonds are going to have options, and the people without them are going to be stuck. You don't have to love bonds, you don't have to put half your portfolio in them, but you do have to understand them, because once you do, you stop seeing investing as a gamble and start seeing it as a system you can use, a system you can navigate, a system where you're not just hoping things work out, you're building something that's designed to work out. That's the difference, and that's what most people miss.